over the years, I have heard you both say wealth winners and capital killers so many times. But I want to know, I must know exactly what you mean by both of those phrases. Howard, wealth winners.
Okay. Well, firstly, wealth winners are companies that if you invest in them at a logical or rational price, you can be virtually certain that their earnings are going to grow enough, that the share price will effectively grow enough that you will make terrific money out of it if you hold it for a long time. So these are not companies you want to hold for a week or a month. These are companies you want to hold for many years, 5, 10, even 20 years' time.
All right, let's move on to capital killers. Mark, I'll start with you.
Okay,
what exactly is that?
Well, that's fairly obvious. It's a company that's going to, at some point in the economic cycle, separate you from your capital. So in other words, it's
that's a massive statement.
Yep.
Somewhere in the economic cycle,
right. And you know what it
separate you
usually
from your
is?
capital.
Usually it's debt-based. So if you have it, like debt's not a problem until it is. And as Buffett says, debt's a 4-letter word. When interest rates were really low, a lot of companies piled on debt because why wouldn't they? It's cheap and it's not costing them much, and they can leverage up their balance sheet and make acquisitions and so on. And what we're seeing now is because interest rates are going up, those companies are starting now coming under serious pressure. And what happened in the GFC? You couldn't roll the debt over. So if you had a decent amount of debt, you were history. So we don't know when that's going to be because the big cycle's unpredictable, and we don't know when there's going to be a next big crash. So what we don't want to be is in a company that could go under in that situation. So debt's a big part of it, but basically any company that we aren't totally confident can survive through a full cycle, we're not interested in.